Hello, good afternoon. Well, after those exhausting nearly 2 days, I think you will be right now much more exhausted when I will show you lots of charts with macroeconomic data. But I hope I will try not to be long, just to show you the main trends and also what's our view. Not only on macroeconomics, because coface is a credit insurer and we work closely with corporates, so we look also what's happening in corporates. We take a look on payment liquidity, on corporate insolvencies and so on. So for us, it's not only important to, as I said, to take a look on those big information, this big picture, but also more insight to microeconomics. Nevertheless, as the starting point, let me begin with some macroeconomic data. So just a reminder for our region, for Central and Eastern Europe, although I know that not all of you are coming from Central and Eastern Europe, but I always say our region because I'm dealing with this in this region. That's my coverage. So in terms of CEE region, let me remind you that last year, 2017, was the best year for many years, because the average GDP growth in the region was 4.5%, which was the highest rate since 2008. So in a nearly decade, it came back to pre-crisis levels. It was also substantial acceleration after poor 2016, where average GDP growth reached 3.1%. But I think right now the good story ends, because as you can see here on the screen, and here you can see GDP growth rates in last quarters. So this red bar, like here for Poland, is the last quarter, not the last quarter, but the last quarter that we have available data, so the second quarter of 2018. Then we have this gold one is first quarter of 2018, fourth quarter of 2017, and third quarter of 2017. So as you can see, and I think it's clearly visible in terms of the Czech Republic and Romania, we have right now not such high growth rates as they used to be previously. In terms of those data, maybe like Hungary, Poland or Bulgaria, you cannot see that it is slowing down, but once we will have data for the third quarter, which are going to be released in the middle of next month, I'm sure that we will see that slowdown is coming. So I think we have to be prepared that we will have slower economic activity, not a recession in the region, but nevertheless slower economic activity, not as supportive as it was in 2017. First of all, we still have in the region the most important driving force of household consumption. Still what households spend for goods, for services, is crucial here for GDP growth rates. As you can see here, those levels, although in the past or even current levels, lower levels, they're quite high, like expansion of household consumption going by 4 or 5%, it's still a solid level. As you can see, this is right now going down because there's no room for further such a high acceleration. Here in Romania, we had some other issues. They decided not so long ago to decrease VAT tax rates, substantial decrease of VAT tax rates that boosted household consumption, but we do not have any other right now reasons to keep those rates going on. Nevertheless, having said that, the situation from the perspective of households in terms of labor market is still very good one. If we would come back to years like 2013, which was quite poor year in terms of the labor market, we see that unemployment rates were much higher than that they are right now. So you can see that most countries in the region, unemployment rates are below this dotted line, and the dotted line is the European Union average for the whole countries in the European Union. And we have a situation that right now in the Czech Republic we have a lower unemployment rate than in Germany. Similarly, in Poland, it's on a similar level than in Germany, and then we have many countries where unemployment decreased substantially over past years. More to that, talking about those positive impact coming from household consumption, we have growing wages in the region. It's another year of growing wages, and definitely it's supportive for the household consumption. I think it comes with no surprise that this private consumption is the main driving force here in the region. Then other important part is there are fixed asset investments, so other component of internal demand, which was missing in 2016. I previously said that the average growth in the region was 3.1%, and it was the reason why this growth was lower than the potential one that the region is able to generate. It was strongly related to switch to the new EU budget, because the region, Central and Eastern Europe, is still strongly dependent on EU funds, on that funds coming from European Union using for co-financing different investments, mostly infrastructural investment. But we can see that right now those fixed asset investments have started to rise in some countries very high, like Hungary, like Slovakia. But beside that, and I think especially here in Poland it's visible, that okay, on the public side is good, because we have this access to EU funds. We have co-finance various investments, as I said, infrastructural investments, which have significant value. But what's missing, still small and medium companies are quite reluctant to invest. Of course, facing such high capacity utilization, they invest more, but it's not an investment boom what was expected previously, especially when we were in 2016, and it was expected that 2017, 2018 will be years of significant acceleration of investments. So then, going further in this brief picture of Central and Eastern Europe, we have also some different situation in terms of prices. So inflation has already risen, has already increased in 2017 after this deflation period that most countries perceive. But right now, especially in countries like Romania, like Bulgaria and Hungary, we see that prices are going up. As you can see, mostly in Romania, where especially food prices and also energy prices are making those increase of prices higher. But when we take a look at the whole picture, roughly it's more or less in line with inflation targets that are fixed by central banks. So we can say that inflation has accelerated, but it's not very high. But it makes some central banks in the region already to hike interest rates. The Czech Republic, the Czech Central Bank, which is here this yellow line, was the first bank after many years in the European Union to start increasing interest rates. That was done already already last year. Then Romanian Central Bank also joined that club of increasing interest rates that started at the beginning of this year. So far we can see that only the Czech Central Bank is more active in increasing interest rates, but sooner or later also other central banks will join, and both corporates and households will have to face higher financing costs. Of course, here in the region, in the Central Eastern Europe, it's important what the European Central Bank will do. We have in the United States, the US Fed is in the cycle of increasing interest rates, but here in the region it's more crucial what the ECB do and will do, what the ECB does and will do. So I think that the very important question right now is, after this picture of past data, what are concerns for corporates. And for corporates in the region, in our view, the main concerns coming from increasing costs of inputs. There are both costs of increasing prices, like energy prices, commodities. Just by the way of example, we have oil price going like nearly 3 times higher than it was at the beginning of 2016, although still those prices are not as high as they were in the past decade, so that they are still not above $100 per Brent barrel. But looking into past quarters, they are higher than used to be, so corporates have to pay more for their production. And it is seen in the producer price index, which includes prices of different commodities components. And as you can see, those dynamics of prices, this acceleration is higher than the increase of consumer prices. So inflation, just typical inflation what individuals pay in shops, in stores. So I think that's the confirmation that corporates are not able to transform those increase of prices they suffer for final consumers. Obviously they would like to do it, but especially in Central and Eastern Europe, and especially like for example in the trade sector, we have lots of competition, and there's still pressure on margins, and if corporates would like to, or they would do it, they would increase their margins, they would increase prices, that would result in going to their competitors, just their clients would choose competitors. Other factor is that coming from the labor market. So I said that the situation on the labor market is positive for households, but it's a concern for corporates, because these growing wages is the growing cost for corporates, and more to that, there are significant labor shortages in the region. You can see that especially in the Czech Republic we have job vacancy rates which went up significantly, but also in other countries, Hungary, and maybe it does not look very dangerous, but also here in other countries they roughly doubled compared, for example, to 2013. And right now in the region we have most of corporates suffering from labor shortages and quoting that it's a significant barrier for their current business operation and their expansion. So I think it has changed because this first time after many years, or after the collapse of the communism in the region, we have that unemployment rates are on a all-time low in most countries, whereas such factors like labor shortages, which we even couldn't not think about some years ago, are the main obstacle and the main concern for corporates in their business activities. So they just find very hard to hire employees. And here this macroeconomic situation, which was positive and still, although this growth is slowing down, well, I can say that corporates have not had enough time to benefit from that. That's confirmed. We have recently published a publication on company insolvencies in the region, and after this good year of 2017, as I said, with GDP growth accelerating by 4.5% at average, we had company insolvencies increasing in the region. At average, they increased by more than 6%. So those macroeconomics were not sufficient factor to bring payment liquidity, and the overall situation of businesses, well, they just didn't have this chance to benefit fully. And those are results from our latest payment survey that we did in Poland. We do payment service in various countries. In our region it includes Poland. And as you can see, the latest payment survey showed that credit periods increased in Poland. It was published a few months ago, so it increased to nearly 50 days from 44 days. But okay, with credit periods, maybe this is market standard. Some companies, although maybe they are willing to accept those long credit periods, like for example in transport or construction. But more dangerous is here, so payment delays, so after the due date of the invoice. As you can see, as I said, although these macroeconomics were beneficial, we've seen that average payment delays increased from 51.5 days to 62.5 days. So nearly 2 months in Poland, that's the average payment delay. And especially in sectors like construction, like transportation, as you can see, those payment delays averaged above 100 days. So especially those sectors, we have a negative view on those sectors due to this payment liquidity. In our survey, we also asked the companies about how they expect how will change credit periods and payment delays. And here, probably it comes with no surprise. Small and medium companies are in a worse position than large ones. So when we asked if companies expect that the counterparties will increase, decrease, or they will not change the credit periods, only the answer in case of counterparties as large companies was that they will increase. So I think it's a confirmation that large companies often they are willing to use the significant power, the significant size, and that was also confirmed here in the payment delays. Also companies expect that especially payment delays from large companies will increase, whereas in terms of other like small and medium companies, they expect they will decrease or stay at the same level they were previously. I'm running out of the time, so just maybe trying to finish it up. Well, in terms of small and medium companies in our region, we have most companies of small and medium companies in the biggest economies. So in this chart, this bubble size is the number of SMEs in particular countries. And in Poland, Romania, Czech Republic, so those big economies in the region, we have the highest number of companies, of small and medium companies. If we take a look what's their share in the total, so this is this x-axis, we can see that there are not substantial differences. As you can see, more than 99% in terms of a number. There are small and medium companies, but if we take a look on that as the point of view of employer, so here y-axis, there are more differences. We can see that small and medium companies are mostly employers in Baltics. The shares in countries like Romania or the Czech Republic are lower, but still, as you can see, those shares are above 60%. So still small, and we have lots of small and medium companies which employ lots of people. In terms of SMEs, I think it's important also to take a look at their productivity. What's the labor productivity, and this is on this right-hand side chart. You can see that in all countries in our region, we have labor productivity lower than it is in large companies. Here again, probably it comes with no surprise, because those large companies can invest more, they can invest in their capacities, they can use their scale, their size, and so on. But we have in some countries some substantial differences, like Hungary and Poland. And when we take a look at the European Union levels, we do not have any country that is very close to this level in terms of labor productivity. For example, this level of small and medium companies, here, like the average is, we have countries like France or Italy that are here at the average level, and here in our region still there's much more to be at the similar level or quite close level to that what we have in Western Europe, when SMEs are have much higher labor productivity than in Central and Eastern Europe. So I started with macro view, and I will finish also with macro view or macro forecast. I told you that we have to expect weaker economic activity in Central and Eastern Europe, and I think that's the confirmation here, where you have our GDP growth forecast, that in most countries we expect that GDP growth will be lower. Having said that, nevertheless, when we take a look at the average growth, and also in particular countries, we expect this year the average growth will be 4%, and next year it will be 3.5%. So still, this is a good level, it's a solid level, yeah? And let me remind you that this average in 2017 was the highest in a nearly decade, so it was very high level, and I wouldn't like to say that we are pessimistic on the region. Still, we see that region delivers solid performance, but not as good as it did in 2017. And just as a last final point, our country and sector risk assessments. In coface we have country risk assessments, which basically are something similar that ratings done by rating agencies, but difference is that rating agencies focus on sovereigns as issuers of public debt and so on. We focus on corporate risk, not sovereign risk like rating agencies do, but corporate risk. Of course, we take into consideration such factors like rating agencies do, so economic, financial, political situation of particular country, but we add to that also our payment experience in particular countries and business climate assessment in particular countries. Our assessments starts with A1, that's very low, so the lowest risk level. A2, A3, A4, all of that are so-called acceptable risk levels, and then we have B, C, D, and E is extreme risk level. As you can see in this world map, we have lots of red color here in emerging markets, especially in Africa, also in Latin America. Here, Europe and Eastern Europe is not as red as other emerging markets. Our latest decision, because we update we revise those assessments each quarter. Of course, it does not mean that we do it on 160 countries each time, only when there are some reasons to revise assessments. But recently we have upgraded Slovakia to A2 and Croatia to A4 from our region. Previously, last year, we increased assessments of Bulgaria, Hungary, Czech Republic, Latvia, and also Estonia. In this picture, let me just also remind you that we acted quite fast with countries like Turkey, like Venezuela, like Argentina, when we decreased already, I think it was in the second quarter of this year when we decreased, when we've seen that also those poor, weak macroeconomics affected also the corporate side. In our region, in Central and Eastern Europe, most of countries are assessed at A3 level, and that's also the assessment for Poland. We have countries like Romania, Bulgaria, right now Croatia at A4, we have Serbia at B level. We have also sector risk assessments, as I mentioned, and here you have 6 main regions in the world. We have also those sector risk assessments for particular economies. And here Central and Eastern Europe, as you can see, well, the low risk here is low risk, medium risk, high risk, and very high risk. And you can see that we have automotive and pharmaceutical sector in the region at low risk. We have construction and transports at high risk. Other assessments are at medium risk. Unfortunately, I do not have time to discuss it, so I will not do it. If you are more interested, we will leave it for discussion afterwards. But I think that the main point here is that from emerging markets, as you can see, we are kind of outperforming region, because Asia, Latin America, Middle East, those you can see that there's much more risk than in other regions. Okay, so sorry that I'm behind the schedule. Thank you for your attention.
Thank you. chief economist for CEE countries at coface. I think it's very important to look at not just into details, but generally for macroeconomic when you are looking when preparing or updating your SME credit risk policies, and to be careful with some credit appetite and to look at economic basics. But now we would like to talk about exactly data. We would like to talk about details and some real cases, not about just banks, but also about some financial products which can be valuable for customers. And these products can be automated, and this is from risk perspective. We would like to stress the point how it can be efficient for you, how I mean for banks and for the customers. Finally, how automation of exactly factoring products can be efficient. And before, I would like to invite, there will be two speakers, and firstly I would like to invite Alexander Beresford from Finiata, Germany, to share your experience.
All right. Some of the slides in here are from our old VC pitch deck. They haven't changed. The company is still running in the same direction as it was 2.5 years ago. Finiata is based in Germany. 80% of our revenue is in Poland, though. More than 60% of our staff is Eastern European. I think we have 2 Germans or 3 Germans in the management team, and the rest comes from other countries. So it's very much an international company sitting in Berlin. If you want to visit Berlin, let us know. Knock on the door. Finiata started as Bezahlt.de, founded by Sebastian Dimmer, who founded Creditech about 2.5 years ago, focusing on working capital for small businesses. And that mission really hasn't changed. It's just pivoted twice, and now we're basically on a good track. One sec, I gotta click through. This is from one of the first pitch decks as well. We're currently focusing on the working capital opportunity, especially in the underserved market. A lot of people are looking at this segment, but looking at it in Western Europe or looking at it in the US or basically larger markets. We think that Eastern Europe, Africa, Latin America, APAC, especially Southeast Asia, are more interesting markets. And the problem is somewhat the same with cultural specifics. The scale of the problem is pretty large. You went over some of the drivers, so I'll stop repeating it. I think one of the largest drivers, though, of this problem is the productivity per human. The problem is that humans are still driving productivity. This needs to change, or the world is, in certain areas, will outclass the world in other areas. Also, what you showed, like productivity per employee in the EU. I hope that these numbers are not a surprise to anybody, but these are sort of the macroeconomic forces that we take into account. So this is what I want to get into. So the panel is about automation and risk management. This is a CMO view of risk management. So for me, risk means about maximizing revenue and NPS, and hopefully 100% approval rate. We might get there, but we're not there quite yet. And these are the sort of the 5 forces that I think about every day, and we run into every day, not just in Poland, also in Germany, but more so in Poland even. People are facing the same challenges everywhere. First of all, people are still shifting to mobile. And by people, I mean users, and by users, I mean employees of corporations, SMEs, freelancers, micro companies. So mobile isn't a consumer trend anymore. This was already completed 5 years ago. Mobile is now an SME and a micro company trend as well. You need to be on mobile first, and on, let's say, desktop is an afterthought. Now, for the older generation, it's not an afterthought, it's still the main way they interface with the product. But for mobile, especially for the younger generation, this is where they go first, this is where they do discovery, this is where you need to start measuring risk. This is where data points start to be generated. So mobile is where risk management actually starts, and it starts outside your application. You need to be on the platforms, you need to be gathering data in a compliant way, you need to be putting this to work. Otherwise, you're 20 years behind everyone else, basically. Second one is brand loyalty. So there's this funny consideration called brand advertising. I don't think it works anymore. There's no such thing as a brand that you control. You can say like, oh, Finiata is blue, and if they decide it's green, Finiata is green. You're not in control of your brand anymore. It comes down to online reviews, and this is where we learn from our mistakes the most. So we have some pretty bad reviews, but this helps us build our product, and now we have great reviews. I think we're running a 4.7 out of 5 on Opineo in Poland, on about 280 reviews, something like this. It's the red ones, though, that are more important because they teach you about your company. So if you're looking for, let's say, knowledge from this driver, you need to dive into your reviews, start looking at the red ones, and this is how you're going to fix your company short term, you already have a problem if you have a lot of red reviews. Third of all, from a risk management perspective, segment of one is basically where it's at. What was the quote I read a few days ago? Amazon doesn't do personas because personas are for humans, and actually you need to have a persona for each individual unique customer. This persona needs to be real time. So a persona is effectively a representation of a human in a data warehouse. This is how segment of one nowadays works. This is how your risk profile should work as well. Also, these need to change. I've seen personas that are the same after 12 months. Trust me, humans change a lot in 12 months, especially nowadays. So you need to work towards real-time segment of one personas, also from a risk management perspective, because the risk profile does change. You can't wait a quarter for somebody's risk. It can happen overnight. The indicators are there. You need to use it. Third one is data willingness. So there's this, what's the book called? So Sapiens, and then Homo Deus, from an Israeli author, I'm forgetting the name, has an interesting theory about dataism and dataists. Sort of, you used to have Christians and Jewish people and other religions, and now you have dataists. And this is effectively a group of people, they don't know it yet, but they consider themselves religious through data. They measure themselves, they see themselves as their profile, basically their representation across data warehouses in the world. And this is now your religion. If you think you're an atheist or agnostic, you're actually a dataist because your representation in society is depicted by this data. So you will have customers that will not want to give you this data, and you will have customers that want to give you this data, and you will have customers that don't know that this data exists. And for each of them, you need to know how to measure their risk, because if you can't, then you can't serve this segment. So you need to have 3 different, let's say, fracturing strategies. Otherwise, you're underserving your segments. So I won't say that we're doing this perfectly, but I think we're on 2 of the 3 are doing quite well. And then average customer experience. I'm Dutch, I'm quite direct. A lot of the experiences that I run into nowadays I feel are 15 years or even more out of date. And I'm 30. I'm really old compared to a lot of people out there. Their experience is, there's just a different expectation. So if you are not going to provide let's say this expected experience and keep up in a world that is accelerating in terms of change, then you regress. So you want to be progressing, and I think we got too used to progression in the last 15, 20 years. But most companies are now regressing, they just don't know it yet, and they'll start to see this in their numbers and in their NPS at a certain point in time. So from a risk management perspective, you can't serve a customer if you can't give them the right customer experience, because you can't gather their data, so you won't be able to serve the segment. It sort of starts there already. These are from our own learnings. I think some of them we've picked up online and worked with them, and the other ones we've just run into ourselves. And I think these are the strongest drivers of, let's say, macroeconomic forces on Finiata, if Finiata was an economy of its own. So how are we starting to solve this problem? The typical story around AI, but we think that there's a portion of reported data, a portion of behavioral data, and then in the SME and freelance sector, financial data and accounting data. So we started in factoring. This is just the start. You'll see some press releases coming up in the next few months. And this is going to evolve quite quickly into its own little machine. So we've built a machine. It's called, actually I'm not going to share the name, so machine with no name for now. And this machine makes decisions, and this machine is now more effective than humans in making most decisions for our company, and this machine is now basically learning on its own. So this allows us to learn fast, this allows us to build for customers, because I think Amazon has it by the right tail end. You should be focusing on customers and not on competition. Customers are where it's at nowadays. A competition-driven view of the world is not going to be very helpful, because information is getting more perfect over time, and customers are getting more picky. And going back to these 5 forces, your customers are in control now. It's not your competitors that are in control. So our fundamental belief is business models need to change quite rapidly. A good example is the Red Hat acquisition of IBM a few days ago. This is a bold bet. And why is this a bold bet? Because IBM's business model doesn't work to a large degree anymore. So you have to go out there and pretty radically change your business model. Fundamentals like income statements are out of date. So who here has an income statement that has a cost of data as a line item in it? Can we see hands? Like cost of data as a significant expense as a line item in your business model. So this is where we are. I'll put my hand up. Cost of data is for us one of the key drivers of the business model, because we can't succeed without data. you're all sitting on data, there is a cost and a value, and you sort of haven't figured it out quite yet. And we want to do this together with other companies. We basically take your data in a compliant way, and we turn it into value for you and your customers. Optimization is also quite key. From our experience, businesses tend to get stuck in their ways, and because the world is accelerating, you really need to move faster. Weekly, quarterly. Our marketing team, for example, is run like a product management team. We have a ticketing system, we do feedback sessions, growth sessions on a weekly basis, and this is for me now de facto way of doing go-to-market. Like marketing is now product as well. And I'd say too much type 2 versus type 1 decision discussion still going on. So we have a banking partner, BNP Paribas Bigajit here in Poland. We're very happy with them. We've seen that when we talk with other banks, there's a lot of they think there's type 1 decisions going on, so irreversible decision, we can't come back from this. Well, actually not true. Most things are type 2 decisions, they just cost a few million euros. So if a few million euros is the opportunity cost of success, we need to step away from this and start investing in the business. We're happy to do this with you. We have plenty of money ourselves as well, so we do this together with our partners. And I will shamelessly say I stole this from our data science team. I don't know what nonlinearity of factors means. They have explained it, and basically this tells me our machine is now on a segment of one basis. It's working in a better way, and it's making decisions on a segment of one basis, and this is a depiction of one of the features in the system. So this is a visual representation of our business decision making now. This is how decisions are made. Final slide. I think I have 5 minutes left. It took me 5 minutes longer than expected. One, I'd say try to radically change your business model. I was at PayPal for 4 years before. I've seen fintech at scale. This is a very different business model than, let's say, the other large companies that I've seen out there. Second one is risk and NPS are intrinsically linked. Your customer NPS, you can have a happy rejected customer. You need to think about it like that. Or you can nearly accept everybody from a credit perspective. Third one is rethink your front end. As a CMO personally, I think if you can't offer a great experience, and we failed to do this in the beginning hardcore, if you can't offer a great front end experience, it doesn't matter how much IP you have, how much back end tech you have, how many data scientists you have. This needs to be amazing, because Amazon is the benchmark, and well, go and try it Amazon if you haven't tried it out yet, one of their $20 billion companies. And the fourth one is, of course, optional, but feel free to integrate Finiata. We have an open API, but we're happy to help you integrate it as well. We've done it with a few partners already. And that was it.
Okay.
Do we do questions now or not?
No, during the discussion.
Oh, okay.
Questions? Would you like? Okay. Okay, let's do first.
Yes. Hello.
Hi. So I have a fintech company also.
Which one?
It's Quick Cash we were presenting yesterday. But in any case, what I'm interested in is you mentioned about the cost of data and monetization of the data that you are sitting on, or maybe you are not sitting on the data and you are extracting that data. So first of all, can you elaborate more on that? And then what is the, I don't know what Finiata is doing. But
Maybe I should add that to the deck in the future. Yeah, good point.
Sorry, yeah, but what is the core business of Finiata, and then how you monetize the data?
Okay. Three questions in there. The first two around, can I be more specific and elaborate? Each data point is effectively towards a business objective. Otherwise, this is called big data, and people gather and they have no idea how to use it. You don't need big data. You need a couple of gigabytes to run a pretty big company. Each data point is towards a decision in a specific mathematical model. This means that this decision has a certain business value. This means that you need to calculate in your business cases the value of each incremental negative and positive data point.
Yeah, but how you do that? Actually, I'm doing this also in my company, but I'm asking how are you doing this?
Finiata does microfactoring and bullet loans for companies. So we lend out money and then we get paid back, or we don't. Quite often we don't get paid back in the beginning, and that's getting better now. So we do that based on negative data points of repayment. So we will optimize towards the value of a data point, and if a customer is quite high risk, but the data is valuable, then this is worth it to us. We'll help the customer with working capital. High chance we don't get paid back, but our model and our Genie has gotten X% better. So we look at it from that perspective, basically. It's part of our weekly KPI meetings.
And BNP Paribas is the lender, so they have it on their balance, or
No,
they are
it's-
the
it's-
on-balance sheet lenders?
We are in effectively a completely outsourced product for them. They wanted to provide working capital to small businesses in the form of micro-factoring and bullet loans. It's our balance sheet, our decision-making, our operations. They simply were looking for somebody that could feed this need. They were not able to build it themselves in the time frame that they wanted. So they went out to the market, asked, and we won the RFP, and we basically do the product for them. It's co-branded, Finiata BNP.
What, like a white label?
No, not white label.
No.
It's basically Finiata branded. I think we have the BNP logo inside the app, and other than that, it's mostly Finiata branded. They're our only banking partner, though. We do different. We're talking white labels to some other banks, and some other ones we're doing no co-branding at all. We've seen different operating models that people are interested in.
Thanks.
Okay, thank you, Alexander.
Cool.
And now we will talk about how really to automate factoring in SME and how it helps to manage risk management. You're welcome, Daniel Huszar from efcom.
Hello guys. Hello. Yeah, we almost made it. This is always the best. I call it the graveyard shift. So it's good. So I represent efcom. We have been serving banks and fintechs for 18 years now. I mean, more banks back in the year 2000, and helping them to scale their factoring business with a core system for factoring, actually a sub-ledger, and we added onto the functionality bit by bit. And now I will talk about SME factoring automation with risk as an example, and that ties in wonderfully actually what we just heard now on a more high level, because I'm going to give you two examples actually on really how to simply automate things with some, let's say, low-level AI, but also tied in with a self-learning system as well. And I'm going to give you some examples on how that works, on how that we actually do it at the moment in our customers, of course. So, yeah, well, we had the mobile first pitch basically just now, and this is exactly why this ties in so well, because this is our SME customer, and that's definitely me. 5 hours of screen time a day, at least, at the very least. You know, we are addicted to these devices, to our smartphones and tablets and all of these things. And yeah, and the thing is, and that's not a big of a problem. Why do we need automation? You know, there's not a lot of these guys around actually, and at the moment. But it's, you know, this is why we have the fintech approach basically, to easily onboard SME clients so they can upload invoices to the mobile. Actually, we can do some deals that are single invoice based even, or with a package of invoices. But in reality, it looks more like this, right? So we get actually a lot of data and a lot of data points to analyze. And my main point is that since a lot of years actually, not any human can really process this kind of information. And this is why we need automation to kind of translate our business decisions in automated decisions through parameterization. And in the next step, what we already heard through machine learning, that the decisions are actually taken automatically, completely automated. And since we have all this data right now, this is what it looks like basically. It can be huge chaos within our system, and we can't really pay out everyone, and we can't only use spread as risk analysis. This is not a good business practice. So we onboard all these customers, but actually we need to have some order in this chaos, basically, so we can make educated decisions of what invoices to buy, for example, which customers to onboard, which customers to reject, and to pay them out fast or to reject them fast. For example, or set up a reasonable limit to leverage our risk. And this is what I'm talking about. So first of all, we need to have a completely analog process and think about our business, what we want to do, what our risk appetite is, and create a risk profile for ourselves. And my examples will focus on risk analysis of invoices, of buying them, and see if they're fraudulent or not, or are most likely fraudulent or not. So, and if we can see this and we have a decision-making engine behind that, this is when automation actually starts to get really interesting, because we can scale the business, and this is what we actually do for our customers. Since 18 years, we help them to scale their business and to just onboard more customers, to have a higher volume without hiring more employees, and in the end make the best possible decisions. So the first example is purchase check criteria at the moment, and the second example is invoice verification. So if I talk about purchase check criteria, I mean the situation that we onboard, let's say an SME client through our web portal, and we decide to accept the client and go to maybe even have an ongoing business with them, and then they will upload some invoices. Maybe we even set a limit for them, of course, after careful consideration. And then we will have some certain criteria of invoices we will reject at any time, for example, because it doesn't fit our predefined risk profile. And we have this entered in the backend system, so they upload the invoices, and then we have a data cruncher in the backend. And this will tell us basically through parameters, we told the system, okay, this is invoices that you should purchase, and these are invoices you should not purchase. And I will just give you a rundown of some criteria on how we think about this and our clients think about this. So of course you can have a minimum amount that's basically worth buying. It's an invoice worth buying. You can have a maximum amount that's too high for that segment of customer, for example, or that's too high in general. Yeah, it's all possible. Of course you set up a limit per client, for example, due to their risk profile. You can have even concentration on top of that. So maybe you don't want to be so deep in construction. That's good. In construction, in construction, you might want to limit your exposure there, and you can also enter this. So it will actually not go on a client level or even an invoice level, but it will take construction as a whole, the invoice, and limit your exposure there to a certain extent. Then, of course, you can have kind of a rating based on invoices. This is interesting, that you can analyze the last 30 days of a client, the uploaded invoices, in comparison to, for example, the 90 days before that. And if there's a huge discrepancy in that, you can lower the limit, or you can reject certain invoices, or for example, call your client and say, what did really change in your business? I cannot make out what really changed, basically. And if you talk about quality of invoices, of course, the due date is very important with that. We have a standard of 90 days, and 91 would be too much. But of course, depends on your risk appetite. And all of this is basically about flagging these invoices, rejecting them automatically, or even having a risk message popping up so that human can take an important action with our most risky invoices, with our most risky clients, and maybe calling them or calling the debtors and this kind of thing. But this here is actually only the process of uploading the invoices to the front end, to your web portal or to your app, and automatically the engine will automatically decide which ones to buy and which ones not to buy. So that's the first part. And the second part is maybe even the more interesting one, because now we have a self-learning system at work, which takes this big data buzzword, which takes all the invoices and puts them into a funnel, a predefined filter that we have right there, matching with certain criteria, and sorting them meaningfully, so a human can interact with these invoices. Give them a certain risk score, for example, and have, for example, a list for your knowledge worker, for your customer agent. So to call them and say, you know, or even call the debtor, for example, and say, you know, what is happening here? To give them the most meaningful tasks within a day to do out of all these maybe hundreds of thousands of invoices that you have in the system. And just to give you a couple of examples on which criteria we work with, of course, turnover, complete turnover of the client. Then the really nice, the Beresford patterns, so in general, pattern recognition, and this is where the system learns in itself as well. We are looking, because we humans are really bad at, if I wanted to defraud a factoring company or a bank, I would be really bad at making up all these numbers, let's say the amounts, for example. And I would have some repetitions. Maybe I have a preference for the number 2, and the mean average is I don't know, that it should be a 1, for example. So these invoices will get flagged, and they will get picked out of this with this filter, and there will be an action required actually to verify that's a real invoice. The quality of invoices, we will see if there are a lot of disputes, for example. Yeah, a lot of credit notes, for example. We see maybe the service is kind of deteriorating. Yeah, we will see there might be a problem. Yeah, we don't know, but we can verify it. And yeah, and for example, has this and really simple ones is, has this invoice been issued as at a weekend, for example? For some businesses it's okay. For some businesses it's very much unlikely that this happens, because it would happen during working hours, of course. And there's so much more that we work with these filters. And so in the end, for the road ahead, this is really these are just 2 examples on how to automate things, how to let's say give your people the most meaningful tasks to do, and how to handle your risk better. So the first example was really about automating purchasing and financing the invoices. The second example is really on manually checking the most risky ones and to flag them and to make sure, that you handle your risk well, basically. And that's it.
Thank you, Daniel. And I would like to invite you to take the place, and I would like to invite all other speakers for discussion panel. Our audience can prepare the questions. Before that, I will make probably a few questions to you. One of them is to be more straightforward and to be more practical. The question will be to Grzegorz. So these guys will come back to the head office, sit, look at your presentations, your graphs, and if you were instead of them, so if you were, let's say, head of SME, what is, let's make a summary. What is your summary of what overlook you presented? So what they should make a more some restricted criteria for lending, or be more, let's say, focus on some industries. So what is 5 maybe key points of your summary from your overall outlook?
Well, I talked a lot about those labor situations what we have in Central and Eastern Europe. And I think that right now companies should adopt to this different reality. And I think that some kind of reply was already provided by all of us. So actually, you, Alexander, talked about labor productivity, which I also mentioned. You also talked about implementing some automatization. And I think it should be inside of companies. And that right now, when we have such labor shortages, when we have increasing labor costs, more and more companies should be willing to adopt any kind of automatization. Of course, I do not mean that they should work only on patents and apply for patent applications and so on, and invent new products. But of course, it would be also great. But also to think about it from the perspective of processes. And I remember recently, because in my work I have to take a look at lots of researches, and that's why I'm usually quoting that, so there will be another one. So recently Polish Central Bank issued one research, and well, it was actually a survey done among corporates, and they asked if they are willing to replace human work by some automatization, by robots and so on. And the reply was, it was not only among SME companies, it was just general in the corporate sector in Poland. And the reply was that 18% of those companies replied that they already do it. But unfortunately, more than 50%, precisely 52% as far as I remember, replied that in their businesses it's not possible. I think this reply will change when they will face more and more labor shortages. They will one day rethink that maybe it's not about innovative products, only innovative products, but also processes, to look at that from a different perspective. And when I check data, mostly in small and medium companies we have this problem, but large companies are open to innovative processes, innovative products. We have really a very low share of companies which do it in terms of small and medium ones. So I think that should be the main outcome that comes from the macroeconomics, because in the region, not only in the region, but considering the Central and Eastern European region, we have negative demographic trends. So this situation on the labor market will not be better, it will be worse. Yeah, we have to think about some immigration, encouraging immigration to come, maybe encouraging emigration, that so people that emigrated from countries here in the region to Western Europe, to other countries, but nevertheless still labor shortages with negative demographic trends, especially shrinking working share of population, that will be a crucial factor in my view.
Okay,
You can just really quickly to add to that, maybe to give also a practical example of what you just talked about. At the moment, this is like coming back to the two examples that I just mentioned with the invoices. Yeah, there's one. This is exactly this. This is very easy to automate because it's a 0 and 1 decision, right? If there's an invoice and it's more than 90 days, for example, I can automate this easily. I will never, let's say, I will never purchase 91 days because it's just too much. But the second part, to verify the invoice, that it's a fresh air invoice, a fraudulent invoice. That's the more interesting part, because I believe what you just said, that this will change, because at the moment the go-to concept is to kind of to analyze it, as I just showed, after certain criteria, and then the human makes the decision in the end, more or less. Of course, with the aid of machine learning also, but it's still some kind of list and a kind of an action plan in the end. Yeah, and I think this is the scary and the more and the part with the most potential, actually, because these more complex decisions, they will be also taken over, and I think you might be on a good way to this, and us too, of course.
We still like people, though.
Okay, and probably already Daniel raised some discussion on next question from my side. And the question will be to you, Daniel, and to Alexander. You already look at some thoughts. You shared some thoughts, and you shared quite interesting idea how to automate it, how to verify the data. But it's nice to probably to business to listen it. But when they come back to risk guys and sit together with them and say, look, I find out very funny guys from Finiata and efcom, they find out how it can be implemented. But in fact, we need, business need to sell it to risk guys these ideas. And maybe maybe you can share with us some few 3 points how it can be selling to risk guys who is more forward focused on data, on some what is behind. After the risk guys, they should come to IT. They will have additional barriers. So, how to automate it? How to effectively implement it into the bank, based on your experience with other banks partners, and maybe also from your personal experience. Yeah.
So as of I think we got that question last week. Like, what about our risk team? So risk is a portion of the balance sheet. It's still just a team that focuses on a piece of the balance sheet, influences the income statement, and this means if you're coming forward with new ideas, try to focus on ideas that don't influence risk. Crazy example: let the startup take the risk. So this is what startups are built for, right? Risk taking, let's say, finding out new business models, innovating. One of my best managers at PayPal, so PayPal, big, successful fintech, great margins, great business, happy customers all across the planet. Even that company could not very quickly go and build something new and take the risk. And this company is probably 30 years ahead of an average, large, older company. So if a large, successful fintech like PayPal, which I have a lot of respect for, is already thinking about this in this way too, I'd say banks, institutions, governments even can go to startups and say, hey, you've got equity, can you take the risk in the beginning? Let's do a pilot, get it to work. And the bank or the institution is effectively a customer gateway. I've heard it literally in those words from a head of a bank recently, sort of the vision of they own the customer and they are positioning a bunch of solutions to problems behind this ownership of the customer. This doesn't mean you need to take the risk, you can also just take revenue share. So you don't necessarily have to, this is not just the risk team, it can be your operations team, it can be the finance team, it can be basically any team in the company. You can find startups that have a configuration that works with this. We do it. I speak from my own experience, so that's how I would approach it. Business models are not cookie cutter anymore. Just come up with a new business model and find a startup that matches it. It can be a startup based in Singapore as well. It doesn't have to be a startup based in Eastern Europe, for example.
And maybe to add to that, if we talk to a banking department, for example, and to the risk guys there, of course, I mean, they have their experience and they don't want it to, to be devalued, or that we tell them how risk works suddenly, and which we don't. Actually, of course, we have some experience over the years, and we have some things that we would recommend. But my solution, and this is maybe to your question, how does it work? We sit down with them with a workshop, really, analog, face to face, and we talk about the options that we have here and the ideas that we have. And then what is really important to them, of course, and we built it so flexibly so we can add to that. And then we will tell them from our experience, this might be a good data point for you to use, or this might even be a good product for you to introduce because we have the risk model behind it. What do you think about this? And this is usually how it works, through mutual respect, actually.
Okay, thank you. Any questions from the audience? Yeah. Yes. Let's say.
Firstly, from Mariam and
during the assessment process of a company, do you assess both the buyer and the seller?
Who, us?
Yeah, that's the company, like granting the financing. Do you assess both the buyer and the seller?
Depends which experiment we're running. Can you hear me properly? So if I understand the question correctly, if we give a positive decision, do we assess the buyer and the seller as part of this decision, or a negative decision? Yes, we do. We also look at far more than that because there are more predictors of success than just a buyer and seller relationship.
Okay, and in case the buyer is a foreign company, how do you assess it? How do you get the data from?
So the simplified answer is the internet. The complex answer depends on the country and accessibility of the data. Here's a good example. So if the seller is in Kenya, so this has a different data infrastructure than Poland or Germany. You need to have cultural knowledge of local data structures, and you need to have a team that is effectively data biz dev. The one thing they do every single day is find more data sources and plug it into the system.
Okay, and if the buyer is in Kenya?
If the buyer is in Kenya, so we currently don't service this model yet. If I think to the models that I do know that do it, it is the same problem. You look for culturally relevant data that is a strong predictor of success. You have database dev that hooks it up. You make sure that this is done real time. Kenya, for example, I would start to look at M-Pesa data. I would start to look at carrier data. Do they send SMSs? Do they have Excel on their phone? These kind of things. This is very much let's say, a data culture thing. So have an understanding of the data culture, or ask somebody to help you understand it.
And in case of a by default, who's abroad of a seller's company, how do you just take the money from them, or you just need to write off for that?
So collections is, I've seen in startups, and we have also learned this, is a huge lever of success of any business model. I guess this is why you're asking the question, right? A lot of the business models even don't work if collections doesn't work properly in a credit space. So honestly, I don't have a good answer for Kenya. I think this is a nut that needs to be cracked. Take a look at what Zimbabwe is doing now, right? They're trying to tap into the mobile money network to suck VAT out of the system. So this means you can partner up with this payment infrastructure to start to, let's say, gain access to funds of users that are out there that are electronically available. So the business model probably relies on that, and it would come less from banking infrastructure, more from payments infrastructure, I would say, for emerging markets. Having seen what I've seen in sub-Saharan Africa, banking infrastructure is far less developed than payments infrastructure.
Okay, so during the assessment process, it's important for you to review and assess the sales purchase agreement, because if you are financing the companies who are abroad, that means no.
We don't
Okay,
look
so
at any agreements or any paper.
Okay, how can then you be sure that there is no unilateral right to apply the set-off or return the goods? How can you be sure on that?
Our prediction relies on completely different factors in this, and our prediction is now, I think, 40% over market standard. This is one way to predict, is somebody going to pay you back? We do it very differently. We also handle the asset differently, for example. I think we do a less traditional form of receivables finance.
Okay, so does it mean that you assess the private individuals of the company you're financing?
I'd hate to steal the panel. I'd be happy to have a discussion sort of in detail later. Can you repeat the question? And then I think.
Do you assess the private individuals of the company you're financing? Then
So
if you're not assessing the sales purchase agreement, you just checking some other data like financial or sales purchase agreement. So does it mean that the big part of your assessment goes to the private individual of the company you're financing?
So coming back to what I said about the segments of like data willingness and data knowledge, we basically assess whatever data they are willing to give us access to, and this varies by person. And we tell them the more data you give us, the better we're going to be at assessing this risk. So for some customers, yes, and for other customers, no. It depends. It's a segment of one discussion for us. Happy to have another discussion later.
And the question to Maria.
Yeah, like quick question to both of you, like efcom and Finiata. So what is the model of cooperation with financial institutions? If it exists already, and what is the model? So how you cooperate, and what do you offer them, and how do you offer?
So in our case, it's probably very different and very easy. Banks and fintechs, they are our clients. So we provide the technology and some experience, of course, and we cater the technology to the needs of our clients. Could be the front end as well. Could be also the back end that I just showed you, which is much more than just the risk part, of course. And and we are happy to interface with any existing system.
It's like a license, or is it a software as a service?
It is both actually. We have both models, but usually the licenses are bought, and then there are certain modules. For example, this is a risk module or a risk package, and that comes on top of that. So it's a very individual product. And to answer the second part of your question, we also have quite a lot of software partners for things, because we are focusing really on factoring, trade and receivables finance with our system. So we have software partners for other things like document management systems, for example, that would be that are really tied in with our application, and that we recommend. But if there's another system which is existing, or even another front end, it doesn't matter, we interface it. basically. But these are the two models. So there's a cooperation with other technology providers and really banking institutions and fintechs are our clients.
We're actually trying to figure it out. We have, well, it's quite difficult. So I used to be running partnerships in France for PayPal and running partnerships for PayPal in sub-Saharan Africa. There's such a wide range and there's no university course on partnerships. So you learn as you go. We have done revenue share, pure revenue share API integrations, and we've done lead generation setups. And we will think about other ways of doing it.
Are you lending?
Yeah, it's all our balance sheet currently.
Okay.
So our decision and our lending, and we're seeing that there's appetite for a whole wide range around this.
Yeah. We are going through the same path, so that's why I'm asking. We have two revenue streams as well. We are lenders based on our decision engine, and also we are providing this as a web service or SaaS model.
Okay, and happy to share more later.
Perfect, thank you.
Other questions? Yes.
I have a question to Alexander. What is the size of Polish market for your product? How would you estimate the size of the market? Like the value of the number of entrepreneurs and
So I look at the problem. Basically, the problem we're trying to solve is I need money now for X. The size of this market is effectively 2.3k times the number of entrepreneurs times financing cycle. So I would look at it like that, and then I would discount people that can't fit in. So total addressable market of in the range of you mean registered or also non-registered people? Give or take 2 million times 70% times 2.3k times 45 days, something like this, for the segment we're in.
okay.
But we serve very small companies, so people do a large amount of revenue. We have some, it's quite funny, they come to us, they should be going to other people. They come to us and they just want 100% online. This is the only thing they care about, and so they use a too high price point on a product that's not optimized towards enterprise. So the target market is people that want to use it. It's not necessarily what we think people should do.
Other questions? Okay, thank you.
Grzegorz,
Yeah. Okay.
just the sort of risks in, or the default risks are extremely high in construction and transport. Is there anything particularly moving that risk at the moment? For a particular reason, which is driving the high risk rate in those different industries?
That what I showed in terms of our sector risk assessments for the region is mostly a result of Polish assessment, because Poland has the biggest share in the region due to the size of the economy, because it's weighted share. And especially here it's confirmed. So one of that is on the construction side. Although, as I said previously, those increase of investments is beneficial for the sector. But unfortunately, this increase of prices is very harmful for the sector at the same time. So we see some companies that are just not accepting previous contracts. They are just rejecting what they agreed before. And especially in the public sector, we do not have mostly indexation of prices. So for them, when they agreed those deals, those agreements in 2016, when prices were definitely lower than they are right now. So there's a substantial difference compared to nowadays. And then again, this factor of labor shortages is especially evident in the construction sector. When I checked sector by sector basis, the construction sector suffers the most among. Of course, we can say about some manufacturing parts and so on, but in terms of those big sections. And last but not least, this is what I showed in terms of our payment liquidity. So payment liquidity, payment delays are very long, and especially in last year. That increased in the construction sector and also in the transport sector. So referring to the other sector you asked. And here,
What's driving it in the transport sector?
well, the transport sector is, we see that in Poland we have a substantial increase of insolvencies, company insolvencies and restructuration proceedings in the transport sectors. In the first 9 months of this year, they increased by 52% compared to the same period of last year. So that's tremendous increase. And here, I think the transport sector is some kind of predictor what will happen in the economy, because it's usually seen when transport is going up, it's feeling positively. Okay, the economy, the cycle is also beneficial. And on the other hand, it also starts to suffer the first when the economy is slowing down or it's going into recession. And in the region, especially in the Poland, we have another factor for the transport sector. So what's abroad, what's in Western Europe? Polish transport companies, road transport companies, are the biggest carrier of international transports in the European Union. They are even, they carry more transports than German companies, than Spanish companies, and other countries, Western Europe, in Western Europe. And here we have first that also in Western Europe the economic activity is weaker, especially even today they released flash data for the Q3 for the GDP growth in the third quarter of this year, and it showed even worse than it was expected. But another factor is that it was depending on the country, but recently some countries like Germany, like France, and other Western European countries implemented some measures which affected transport companies coming from Central and Eastern Europe. I mean here covering by minimum wages in those countries. And you know, the German minimum wage is completely different, and the German and average wages in Germany are completely different than we have in Poland and in other countries of Western Europe. So that was also another negative factor that contributed that this competitiveness of transport companies on external markets, which were that they were able to generate more profits than on the domestic markets, it suffered. Yeah, it decreased, and for some companies even it became not just efficient to stay on those external markets. I think those are the most important reasons that were driven. But of course, what I said about payment liquidity, payment delays, and our payment experience, so what's inside our company, what are views of our underwriters, and then just what is confirmed in data, was here very important.
Okay. Other questions?
Yes, do not be so hurried. Other questions? Okay, so now is finally thank you. Thank you to our panelists for your joining our discussion panel, and thank you for your presentation.